If you ask most people how to build a comfortable life, the instructions are straightforward. Do well in school, secure a high-paying job, and diligently save a slice of your paycheck every month. It is a steady, grinding rhythm. But relying purely on a salary is bound by a strict one-to-one equation. You are trading a specific unit of your physical time for a specific amount of money. That creates a massive point of failure. The exact moment you stop showing up, whether by choice, illness, or layoffs, that paycheck stops arriving. The income drops to zero instantly. To escape that cycle, you need assets. These are structures designed specifically to keep generating value long after you have finished the active work of setting them up. We are going to break down 3 modern asset classes ordinary people use to build fortunes today. We will strip away the internet hype and look closely at the actual mathematics of how they multiply money. True wealth is never built by simply maximizing an hourly rate. It is built by acquiring systems that permanently sever the link between your time and your income. The oldest of these systems is real estate. At its core, owning rental property works by generating consistent monthly cash flow from tenants after the mortgage, taxes, and maintenance are covered. But the real power of property lies in financial leverage. When you buy a building, you rarely pay the full price up front. You put down a fraction of the purchase price, often around 20%, and use a bank loan to control the entire asset. Because you only put a fraction down initially, a 10% increase in the property's total value results in a 50% return on your actual cash investment. The danger is that leverage works exactly the same way in reverse. If property prices fall, a relatively small drop in the overall home value violently multiplies your losses and wipes out your equity. Despite the stories told on social media, being a landlord is rarely hands-off. Tenants call with emergencies at midnight, roofs leak, and a vacant unit means you take a straight loss every month. Building wealth through real estate means you are willingly trading your capital and your patience for operations in order to harness the raw power of financial leverage. Moving beyond physical property, we find the asset class responsible for the largest fortunes on earth: business equity. There is a sharp distinction between working in a business, where you manage daily tasks, and owning the system itself. True ownership means you have built processes and hired teams to run the operations for you. Business valuation follows a unique mathematical logic. When a company is sold, it is priced at a multiple, a calculation that transforms 1 year of profit into a lump sum worth 3 or 4 times that amount. The reality check here is brutal. The vast majority of new businesses fail, and the ones that survive usually demand years of exhausting, unpaid effort before they look anything close to self-sustaining. This engine runs on system leverage. It requires a massive upfront investment of human energy to construct an independent entity that is ultimately worth far more than its yearly income. The newest wealth category strips away physical constraints entirely. Digital assets include online courses, software, and media content libraries. These are exploding in popularity because the internet introduced an economic concept known as zero marginal cost. With a physical product, your production costs climb steadily with every unit you sell. With a digital product, the cost to deliver the 100th unit or the 1000th unit stays completely flat. You can spend a month coding a piece of software or recording a masterclass, and that exact same file can be sold an infinite number of times. There's no inventory to restock and no shipping cost eating into your margin. Because creating digital products is infinitely scalable, the barrier to entry moves somewhere else. The primary bottleneck shifts entirely to the grueling, slow work of marketing and earning audience trust. Digital assets utilize replication leverage. They solve the manufacturing problem, but they demand immense and continuous effort in distribution to actually find buyers. When we lay these 3 engines out side by side, it quickly dismantles the biggest internet buzzword of the last decade: passive income. None of these assets allow you to avoid hard work. Instead, they require you to heavily front-load your labor to build an engine that eventually has the strength to stand on its own. Every single path comes with its own distinct friction. You either need capital to withstand the risks of real estate, the system-building skills to organize a business, or the persistence to slowly earn audience trust for digital assets. You do not need to master all 3. You simply need to evaluate the resources you currently have at your disposal. whether that is cash in the bank, extra hours in the evening, or a reservoir of creative energy. Lasting wealth requires a deliberate choice. Which type of friction are you willing to endure to permanently break the one-to-one equation in your own life? Curious, observant, we constantly chase the idea of an economic machine that grinds forward entirely on its own. The ultimate goal for most investors is the creation of pure passive income. The appeal is obvious. Set up the machinery once, step back, and watch the cash arrive. But this pursuit relies on a mathematical illusion. It assumes a structure can generate continuous output without demanding fuel or sacrifice in return. Every financial instrument extracts a specific toll from the investor holding it. This is the trade-off principle. Whether you are dealing in equities, debt, or digital contracts, the market always exacts a price for the yield it produces. To hold an asset is to accept a specific vulnerability. Look closely at modern portfolios, and you will find they expose you to 3 distinct categories of risk: mechanical failures within the asset itself, the operational burdens of managing it, or massive systemic shocks to the broader market. Surviving the modern market requires giving up the search for a flawless, risk-free investment. The actual task is identifying the exact flavor of risk you are financially and psychologically equipped to endure. Take a portfolio of dividend-paying stocks. You are buying shares in established, profitable corporations that distribute a portion of their earnings as regular cash payments directly to shareholders. This chart shows the exponential growth pattern of dividend reinvestment. Using initial cash payouts to purchase additional shares triggers an acceleration effect. Since your share count increases, your next dividend is calculated on a larger base, creating a closed, self-feeding loop compounding aggressively over time. The mechanical catch to this system is the staggering amount of time required to see meaningful momentum. It is an absolute, rigorous requirement to wait. Unlike a standard salary that compensates you immediately for your labor, a dividend strategy takes decades of agonizingly slow growth to develop into an income stream that could actually cover living expenses. The primary threat to this approach is not a sudden market collapse. The real danger is behavioral risk, the high probability of the investor getting bored and abandoning the system long before the math actually has time to work. Royalties offer an entirely different proposition. By creating or licensing intellectual property, like a song or a book or a piece of technology, a single upfront effort can theoretically yield recurring payments for the rest of your life. The main draw here is a clear division of labor. You do the creative or technical work once, and someone else handles the daily operational grind of actually manufacturing, distributing, and selling the product to the public. Look at this distribution curve of the creative market. A massive concentration of data points flatlines at 0, while a microscopic fraction spikes violently upward. Returns are wildly unpredictable. Because the vast majority earn very little, relying solely on royalties is deeply unreliable. The trade-off for the dream of lifelong, hands-off payments is committing to an asset class where success routinely defies traditional financial modeling. If we move out to the volatile frontier of digital assets and blockchain networks, the environment shifts completely. Certain investors pursue yield opportunities native to the crypto ecosystem itself, like staking. This involves locking up your coins to help secure a network's operations and receiving a percentage return in exchange. The catch here is the speed and severity of the price action. These networks are capable of producing extraordinary gains or equally catastrophic losses within extremely compressed windows of time. Unlike fixed income from a major government or corporation, this space operates with virtually none of the traditional regulatory safety nets. If a platform collapses or a network is compromised, there is no central authority to step in and restore lost funds. Risk in this space involves the literal survival of the asset's underlying infrastructure, a threat that exists outside the normal patterns of the business cycle. Chasing these specific, high-yield digital opportunities requires you to accept direct, unfiltered exposure to sudden existential system failure. When you look closely at these mechanisms, the definition of an asset changes. It stops being a simple tool that generates money and becomes a specific, quantified profile of risk. A robust financial strategy requires accepting that complete safety is mathematically incompatible with portfolio growth. To gain anything, a vulnerability must be introduced into the system. This Tensegrity model demonstrates true portfolio diversification. Rather than just holding a random assortment of investments, a durable strategy carefully links entirely different categories of trade-offs, like time, asymmetry, and volatility, into a single interconnected structure. By intentionally isolating the highly volatile elements within specific parameters, the structure shifts its weight to protect the slow, steady anchors that stabilize the broader portfolio. Effective wealth building comes down to selecting the specific trade-off you are genuinely willing to live with.
I mean, if you spend any time online at all, you're constantly bombarded with chaotic financial noise, right? It's usually teenagers on TikTok yelling at you to dump your life savings into whatever the latest meme coin is. But the thing is, almost all of that advice completely misses the reality of where most of us are actually starting. So we're going to cut right through all that noise today and map out a genuine step-by-step beginner roadmap. Because really, this right here is the core problem. How do you actually build wealth when you have literally zero capital to start? It is incredibly frustrating to read a book or watch a show that essentially tells you the big secret to getting rich is, well, to already have a bunch of money to invest. Mainstream financial advice pushes these capital-intensive assets onto people whose bank accounts are completely empty. It's exactly like being told the secret to winning a race is to start at the finish line. But today, we're looking at the actual starting line and exactly how you cross it without a single dollar of starting capital. To figure this out, here's our roadmap for today. We'll start with the hidden assets. Then, we'll look at accessibility and risk. Next up is wealth sequencing. After that, we'll cover the failure mode. And finally, we'll wrap up with your exact starting point. All right, let's jump right into part one, the hidden assets and the highest ROI starting points. So, these hidden starting assets almost never show up on a traditional bank statement or balance sheet, but economists call the most important one human capital. Interestingly enough, if you look at a typical master list of 15 wealth-building assets, this one is usually way down at number 14, and it is by far the easiest one to overlook. Why? Well, because pretty much every other asset requires some starting capital or, pre-existing audience. But a genuinely valuable, in-demand skill, whether that's coding, sales, a specialized trade, or some creative craft, requires absolutely neither. It can be built with pure time and effort. It directly increases your earning capacity for as long as you're able to work. And here is the absolute best part. It is very likely the single highest return on investment asset available to a beginner, simply because nobody can repossess it, nobody can devalue it, and nobody can take it away from you.
And right next to that is the 15th and final asset on that master list, network and reputation. It's kind of crazy to realize, but social trust is literally a highly leveraged starting asset, and it behaves in a very concrete way. Think about it. Opportunities, partnerships, introductions, and deals routinely flow specifically through trusted relationships, way more than they do through cold public channels. A really strong professional network can shave years off the time it takes to build any of the other assets. Because someone who already trusts you is infinitely more likely to invest in your business, buy your product, or refer you to that one massive client that just changes the whole shebang for you.
Okay, moving on to part two, accessibility and risk. Because as you'll see, not all assets are created equal.
When we actually map these out, you start to see a really clear ladder for this beginner roadmap. At the very top, things like skills and network, they cost time, not capital, and the risk is super low. That makes them the absolute perfect, most accessible starting point if you're short on cash but have real effort to give. Now, as you move down the ladder, dividend stocks and bonds require moderate capital, but not a ton of specialized expertise. So, a great entry point once you actually have some savings. Then you hit real estate and business ownership. These require high capital, high operational effort, or honestly, both. But that difficulty and moderate risk are exactly why they produce the largest fortunes, right? The reward scales with the difficulty. Finally, way down at the bottom, crypto and collectibles sit far out on the risk spectrum. Sure, they can offer strong returns, but they're also capable of devastating losses that conservative assets just aren't exposed to. You really have to climb this ladder logically.
Which brings us to part 3, wealth sequencing. This right here is the secret of the wealthy.
If you take only one thing away from this explainer today, let it be this. Lasting wealth is almost never built from a single lucky windfall or by picking one random asset on a list and blindly going all in. It's about a very specific sequence. Step 1, you build a skill first, precisely because it costs nothing but your time. Step 2, you use the income generated from that newly mastered skill to fund a small ownership stake in a business or a piece of real estate. Step 3, you use the profits or the equity from that business or real estate to begin building a stable, long-term portfolio of dividend stocks and bonds. And then finally, step 4, Only then, once a real foundation actually exists, do you allocate a smaller, much more comfortable portion of your total picture toward those higher risk, higher upside assets like crypto. The income from one stage strategically and safely funds the foundation of the very next stage.
Now, wealth built this way, yeah, it's definitely slower to show up on the outside. You're probably not going to have some wild, overnight, before and after moment to flex on social media. But guys, it is far more durable. It's practically unshakable because it isn't dependent on any single asset performing perfectly all the time. If your high-risk assets take a sudden hit, your foundation remains completely 100% intact.
Let's look at part 4, the failure mode, or why going wide instead of deep is a total trap. So many people fall straight into what we call the 15-way split. They see this massive menu of exciting financial assets, and they literally try to grab all of them at the exact same time. They end up spreading a tiny amount of capital and honestly an even smaller amount of attention incredibly thinly across everything. And the result? They just end up with a shallow, completely undercapitalized position in each one instead of a real, meaningful stake in anything. But the people who actually build wealth, they take the concentrated approach. They go deep way before they ever go wide. They master one or two of these asset types thoroughly. They take the time to really understand exactly how the income, the risk, and the growth mechanics actually work before they even think about expanding into the rest.
Because, to put it simply, a tiny amount of money split 15 ways doesn't compound. That is the fundamental mechanic of wealth building right there. Compounding absolutely requires a meaningful amount of money or a meaningful amount of focused effort, concentrated in well-understood areas. Dilution is literally the enemy of compounding.
Finally, we arrive at part 5, your starting point, and exactly where you should begin today.
If you're staring at the vast world of finance and trying to figure out where on earth to actually start, here's the honest answer. You've got to start with whichever asset requires the least capital relative to what you currently have and the most time relative to what you are currently willing to give. For most of us building from nothing, that means building a skill first with pure effort. And remember, you already have the primary resources needed for this, your time and your dedication. That skill quietly makes every single other item on the wealth list so much easier to acquire later on. You know, wealth was never really about which 15 boxes you can check off a fancy graphic. It's about deeply mastering one or two assets thoroughly and then just having the incredible patience to let compounding do its work long after that initial excitement of starting has worn off.
So I want to leave you with this one final thought to ponder. If human capital really is the foundation that unlocks everything else, which one skill will you build today to fund your future portfolio? Seriously, don't worry about the 15 different things you could be doing. Just pick one skill, focus your time, and start building your durable wealth today. Thank you so much for joining me for this explainer. I really hope it gave you exactly the clarity you need to go out there and take that first step.